streaming on News 9 Plus. Subscribe and get free vouchers.
It's not the fiefdom of politicians. They owe it to the people. Matter is now more about faith of the millions of devotees than just political slugfest. Does that mean that I can't get a job in Chennai, although I may be best suited for that particular job? They have more civic sense, they have more of civility than all these men. My name is Sudha Sadanand. Welcome to the South Indian.
Very good morning. You're watching News 9 Live. I'm Kartik Malhotra, and over the next hour, we'll bring you all the top business and economy stories that will have an impact on your life. On the show today, we'll understand what the CPI inflation print means for you, the consumer, with Yuvika Singhal, economist at Contico. Also on the show, the market sell-off, the frenzy of FPIs pulling out amid a weak rupee and rising crude oil prices globally. We'll understand the impact on the markets and the impact on your investments with Mohit Gang. And also on the show, we will have Som Kapoor to understand and distill for us what the new EV policy could look like. You're watching Morning Brief at 9. This is Morning Brief at 9 right here on News 9 Live. First up, a quick look at the headlines. December inflation cools to 5.22%, down from the November print, but food inflation continues to remain high at 8.39%. What it means for you, the consumer, we'll address on the show today. Meanwhile, the rupee slides below 86 rupees against the dollar. What does this mean for those looking at traveling abroad as well as for the Indian economy? And Indian stock markets bled again on Monday on weak rupee as well as the oil shock. Remember, crude oil prices hovering in the range of $85 a barrel. Fintech and discount broker Grow is likely to launch its IPO in 12 months from now. It is targeting $800 million as IPO proceeds. And staying with IPOs, Lakshmi Dental IPO subscribed 5.28 times on day one. IT Minister Ashwini Vaishnav calls out Mark Zuckerberg's poll comment, saying that post-COVID, the year 2024 did not see the return of incumbents. IT Minister Ashwini Vaishnav does a fact check on Mark Zuckerberg. And according to media reports, the government has invited Elon Musk for consultation on the EV policy. Remember, the EV policy was announced in March 2024, seeking investments from Tesla. China's exports touch record high at $3.5 trillion, up 7.1% year on year. And an update on the LA wildfires. There is the Santa Ana winds likely to further add chaos and disruption in South California. Donald Trump is reportedly likely to visit LA amid the wildfires. Our top story this morning comes by way of the inflation print released by the government yesterday. India's retail inflation has cooled slightly to 5.22% in the month of December, down from 5.38% in the month of November. This aligns closely with market expectations of 5.3% and stays comfortably within the Reserve Bank's target range which is 2% points either way of the 4% mark. Now, what's driving this cooling to a 4-month low? Well, food prices, which make up nearly half of Indian consumer basket, eased to 8.39% from 9.04% in the month of November. Among key categories, vegetable inflation has also eased, even though it continues to be high at 26.56%. Now remember, this was at 29.33% in the month of November. Meanwhile, pulses inflation has also moderated to 3.83% from 5.41% in the previous month. Meanwhile, rural inflation was recorded at 5.76%, a decline from 5.95% in November, while urban inflation has eased to 4.58% from 4.83%. Housing inflation has also dipped a little bit. Plus, retail prices fell by half a percentage point on a monthly basis. That's the sharpest monthly decline in over a year. Now, all signs are pointing to some relief for consumers, but the big question remains, will RBI cut rates in the February Monetary Policy Committee meet, the first to be chaired by the new central bank governor Sanjay Malhotra? Well, Yuvika, single economist at Quant Eco, joins me this morning. Yuvika, good morning. Thank you for joining us right here on Morning Brief at 9 at News 9 Live. I want to understand from you, number one, there is a cooling off in the inflation print for the month of December. But this still means that prices will continue to rise, albeit they will rise a little slower. What do you make of the December print and what does it mean for the consumer?
Hi, morning, Kartik. Thank you for having me. So, as we all know, the inflation print that we saw for the month of December only recorded a modest decline vis-a-vis the November print, and just about 25 basis points of decline, which was sequentially, as you pointed out, led by food and beverages category, within which we saw items such as vegetables, spices, pulses correct meaningfully in the month of December. However, having said so, despite the sequential correction that we saw in food and beverages index, within which vegetable prices, the headline correction was fairly disappointing, to say the least, just about 25 basis points, like I said. Now, we have to understand that the seasonal correction in prices that was to transpire in the month of December with the onset of the winter seasonality did not kick in the way that we had anticipated. More so because this year, if you would recall, between June to October, price pressures had really flared up, led by vegetable prices. So given the kind of extent that we had seen in the price shoot up in the previous months, we had expected, or we could have expected, the normalization to have happened at a fairly faster clip up till the end of December, which did not transpire. And that's the reason why you see only the headline inflation coming off slightly. So we would probably see this print as being in the right direction. Food prices continue to correct, and so does the headline inflation. But I would still attach a certain degree of downward rigidity to the December print, because the kind of correction that we would have probably built in a month or two ago did not transpire until the end of December.
Yuvika, but where do you see the trend going from here? Do you see Jan to be a better month than December, or is it too early to try and establish a trend line of inflation figures really coming down?
So as of now, it does seem that January print is going to offer a fair degree of comfort. And while it's still early days yet, we have not even touched midway mark of the month of Jan, but we have high frequency data coming in from the Mondays, and the data that is available for the early 10-11 days of this month do point towards a fairly sizable correction in vegetable prices. In the staples, which we typically look at, potato, onion, tomatoes, which were also the source of high degree of acceleration that we saw in the previous months. But also there is a fair degree of disinflation that is being seen in the Jan prices for a lot of other vegetables, which are typically what we call winter vegetables. So there is likely to be a broad-based decline as far as vegetable prices are concerned in the month of Jan. That is what the early indicators are pointing out. In addition to this, remember that the Rabi season sowing is fairly complete, and there is a fair degree of possibility that the wheat production is likely to be at a record high. There is also traction in pulses sowing, and that could translate into a good pulses output. And we have already seen some degree of respite in the sequential price pressures that we have seen in wheat and pulses, especially in the month of December. So there is an inflection point there that it's visible as far as food grain inflation is concerned. To put together, we will or we are likely to see both vegetables as well as food grain inflation probably now correct at a more meaningful pace in Q4, and that should pull the headline inflation number below 5% in Q4, that is Q4 of FY25, and we are likely to see inflation, headline inflation in the range of 4.5% to 5% through Q4. That's right. What we are looking at this point in time.
4.5% to 5%, still above the comfort zone of the RBI, which wants to hammer it down to 4%, if not below that. But better news coming on core inflation, which strips off energy and the volatile food prices. Now, that has comfortably come below the 4% mark, and that is something which is likely to stay, even though there is volatility and rising prices of oil globally. What I want to understand from you, maybe early days, maybe not, but about a month to go for the next Monetary Policy Committee meet. In fact, the first to be chaired by the new RBI Governor Sanjay Malhotra. Do you think there is a chance of the rate finally getting cut by at least 25 basis points? Some analysts, some experts do believe it is time. Before you answer that, just for our viewers, a cut in interest rates will mean that your fixed deposits are not going to fetch you the kind of returns that they have been fetching you so far, but cut in the interest rates will also mean that your loans become cheaper. So, Yuvika, let me take this to you. Any likelihood of a rate cut by the RBI next month?
So looking at the downward rigidity in inflation for the months of November, December, and mind you, keeping in mind the global situation, especially the Fed sounding more hawkish in recent times, also we have seen a fairly brisk pace of rupee depreciation. And remember, rupee depreciation is also likely to have an impact on inflation. There is a certain component of imported inflation within the entire CPI basket. So keeping in mind where we have seen the December print, even though we do expect January to see a meaningful correction in food price pressures, but the trend up till December, looking at the global situation, there is fair degree of uncertainty in terms of what will happen eventually when Trump comes to power. Tariff wars could, for all you know, have induce inflation globally, and then there is likely to be an impact of rupee depreciation. Keeping all these factors in mind, we believe that the chances of a rate cut look more ripe for the subsequent policy after Feb, that is going into April. So that would be the next fiscal year. For Feb, we think that it would make more sense to stay pat on rates because there's a lot of global uncertainty, and also that RBI would want to wait for the January print to confirm the degree of disinflation that is likely to transpire in Q4. So that is what we are thinking at this point in time. So April more of a likelihood than Feb.
April more likely than Feb. Well, you mentioned the rupee. Just for our viewers, let's understand what is happening with the Indian rupee against the greenback. The Indian rupee took a massive hit on Monday, logging its steepest single-day fall in nearly 2 years. On Monday, it plunged by 58 paisa to hit a historic low of 86.62 against the US dollar. A stronger dollar and surging crude prices weighed heavily on the Indian currency. Now, what's more alarming is the fact that in the last 2 weeks alone, the rupee has tumbled over 1 rupee, dropping from 85.52 on December 30th. The relentless demand for the US dollar by investors is driving this plunge, coupled with a significant outflow of foreign capital from Indian equities. Now, a double whammy for the rupee as global and domestic factors keep piling up. Remember, this also comes at a time when the RBI has been intervening by selling US dollars in the open market operations, bringing India's forex reserves down to under $640 billion. Yuvika, stay with us, but we also have Mohit Gang joining us this morning. Mohit, help us understand this double whammy and its impact on the stock markets. In fact, a triple whammy, one would say. Number one, the weak rupee against a very strong dollar, which is prompting FIIs to pull out, FPIs to pull out and sit on the sidelines of the Indian equity story. At the same time, the rising oil prices, which will obviously cost India dearly when it comes to its oil import. How do you see all of this panning out, A, for the macroeconomy and B, for the markets?
Morning, Kartik, and it's good to be speaking again. Thank you very much. So look, my sense is this obviously isn't shaping up well for India, particularly. Dollar strengthening, and I think dollar strengthening like anything, it's been a crazy rise. The dollar index is almost at around 110 mark. And along with that, I think, look, what is plaguing us is that we have been pretty late on the curve to reduce rates. That's my sense. And now it's a double whammy. It's a tricky scenario whether we go for a rate cut or not because of the rupee depreciation which we have seen. I think it's happened too soon, too fast, right? And my expectation is that we should see a little bit of a pause here or a breather. I think the realistic level for the dollar index should be around 106 odd or 107 odd. Maybe if things settle down post the Trump era, and I think it's more to do with the Trump era just about to begin, that the markets are pricing in a lot of things right now. And I would assume that the nerves should settle in within next 10 to 15 days once the new regime takes over. And even the new sanctions which have been levied on Russian oil per se, I think that doesn't augur well for India. But my sense is it might just be a bargaining chip for the Trump era to come in and try and curb the war from Russia-Ukraine perspective. So putting all in perspective, my sense is oil at around $80 is not great for India, but my sense is we have kind of topped out on that for the time being. I think markets is factoring in a lot out there in terms of Russian sanctions coming in and all those things, but that could be a pretty much a bargaining chip. And even in terms of the currency depreciation which we have seen of late, it was long overdue given the kind of depreciation which we saw across the world for other currencies, and rupee was holding steadfast for last 1 or 2 years, and in last 6 months odd we have seen this slide. My sense is this is also kind of overdone for the time being. Right, I'm not talking long term here. I'm talking a pretty small scenario of around 3 to 6 odd months. Once everything settles down, I think they should take a pause for some time, or perhaps from here on, maybe we see a little bit of oil and currency both kind of helping us up in next 3 to 6 odd months.
All right, stay with me, Mohit. Let me bring back Yuvika Singhal into this discussion. Yuvika, now the RBI has been, of course, on the selling spree of its forex reserves, trying to keep the rupee in some mode of not letting it cross 85. It has, however, crossed 86. But I want to understand, is there a requirement for the RBI to continue its interventions or let the rupee slide to whatever its natural value is?
So I think it's a trade-off, Kartik, honestly speaking. So while RBI wouldn't want the currency to, move in either direction in a very volatile manner. So when it does intervene, it intervenes with the intention that they would want the movement in the rupee to be somewhat curbed, because volatility also hits market participants probably more than what the level of the rupee is. So any unforeseen shocks also are hurting in nature. So I think that is the intention or the view perspective from which we need to view RBI's intervention, that they're not trying to push the currency in a direction opposite to what the market forces are wanting to, but probably kind of curtail the pace at which the speed of the direction in which it's moving. So I think that is the perspective we need to see RBI's intervention from. Having said so, I think the rupee overvaluation does definitely warrant depreciation, largely because we have seen our peers depreciate much more meaningfully in the last 1 year or so, whereas our, the rupee was almost steadfast given RBI's intervention. So I think it's time that we let go to some extent. But again, I think RBI's intervention will be there to probably curb the pace of volatility or to curb the pace of depreciation. But I think the direction is towards a depreciating rupee.
All right, the depreciating rupee. Well, of course, this is going to be a mixed bag and it depends on what the priority of the central bank is. Yuvika Singhal, thank you so much for taking out time. We will continue, of course, discussing this with the Mohit Gang. Mohit, now, what does the sliding rupee really mean for the consumer, the investor invested in the Indian stock market story, as well as for IT stocks?
Look, Kartik, I think a sliding rupee does not augur well, obviously, in terms of FPI or FII outflows, right? And we have seen that happening to a massive extent of late. Look, so the equation is pretty simple. If you have the world's safest treasury, which is the US treasury, coming in at around 4.75% and with the dollar appreciating the way it is very difficult for any FII to make a case for emerging market. Leave aside India. I understand Indian macros and everything, and I think we are shaping up great. But from an FPI allocation perspective, it's extremely difficult for someone to justify a case when the risk-free return is almost 5%, and along with currency appreciation, it just adds up to another 2-3 odd %, right? So that's been something which has been plaguing Indian markets. I think the FPI outflows need to be curtailed. We have very strong, rock solid domestic flows, which are kind of protecting the market to some extent. But again, there's only that much that the domestic money can do in the markets, right? So I think that's the bigger risk. In terms of sectors, I think, look, IT, I still continue to remain bullish. Honestly, I think with US economy going from strength to strength, IT as a sector looks positive to me. And along with the rate cut cycle, still not yet decided which way the rate cut cycle is going from here on. But I continue to believe that we will see more rate cuts coming from both US Fed, and obviously Indian rate cut cycle is yet to kick off. So I think there is some leg up more from an IT perspective. I'm not so much worried about the currency depreciation from an IT perspective, because most of those services are kind of hedged, right? So I don't think so currency depreciation is too much of a worry, obviously, unless a depreciation happens too fast and too quick, which has been the case for last 1 or 2 months. But I don't think that the speed of depreciation will be as high going forward, right? So from that perspective, yes, I think IT looks extremely attractive. And my sense is export of services with rupee depreciation kind of becomes even more attractive, right? The GCCs are gaining traction. That's something which is shaping up very well for us. That's something which will kind of help us curtail our trade deficit to a very, very large extent. And I think with rupee depreciation, it becomes even more attractive, right? So I think those are few places and sectors which looks attractive from that perspective.
Markets have opened and it seems to be a green start for the markets this morning. However, the Nifty is still struggling to maintain the 22,200 mark this morning. Mohit, I want to understand from you, is the next trigger for the Indian markets going to be Donald Trump assuming office, or are there other triggers which the market would be waiting for? And your view on this rally of sell-off and hopefully finally a positive start which should translate to some gains today?
Look, I think there are triggers to be watched out for. The Trump era, I think, is discounted a lot before it has started. My sense is it's a classic case of buy on rumor and sell on news kind of a thing. So I think that's what is happening in the US markets per se, with the Trump era about to kick in. People are discounting a lot as to what is about to happen. And somewhere I think that those trades might just take a little pause, breather, or kind of unwind to some extent. The bigger triggers to watch out domestically, I think, is budget. Honestly, I'll not be surprised if the fiscal deficit number kind of comes out extremely good and triggers the market, right? And the government infra spending number, that could again be a big booster, and perhaps the measures which government might take to revive the rural economy or the consumption on whole. I think those are few triggers and points which I'm looking for, and if those come positive, I think in a market like this which is sold off so dramatically, those could be good cushion areas. And then in Feb, we are watching for the RBI meet under the new governor, and hopefully we might just see start of a rate cut cycle from there on, right? If all of this happens together, a combination of this, which is the trade which is ushered in because of Trump era coming in, kind of taking a pause or breather when he actually comes in and takes charge. The budget being extremely good and giving a boost to rural spending and giving a boost to infra employment kind of places. And the third is the RBI policy meet. If all three of these come together and the earnings seasons is a little modest, honestly, I'm not expecting great things from the earnings season, but if it is a little modest also, then I think we have a case for the markets to again look upwards.
Right. Well, when we were talking in the month of September, October, Mohit, I think the assumption was that Sensex is likely to touch 1 lakh by December. Obviously, that hasn't happened. In fact, if anything, we've gone in the other direction. But Nifty right now struggling to even hold its support levels of 23,250. Now, even with these positive triggers, the likely positive triggers that you're talking about, and I'll recap the three of them. One is Trump assuming office and no bad news on tariffs. Number two being budget giving some sort of a fillip to consumption, agri sector and the infrastructure push, and number 3 being by way of the Monetary Policy Committee later after the budget, but in the month of February. Looking at all this, what do you see for the year 2025 as an upside for Nifty?
That's a very difficult case to put in, Kartik. Honestly, I'd not like to go with a number, but yeah, I would still want to stick my neck out and say that we are headed for a 10th straight positive year in the market. The extent and magnitude might be too modest for anyone to call it out. Look, it could be low single digit number for all it matters. But my sense is we are headed for a 10th straight calendar year of positive markets.
10th straight year of positive markets. Now, in other news, Mohit, I want to discuss a few sectors and stocks with you. I'm not looking for an intraday trade call. I'm actually looking for your long-term view on those sectors and those stocks. To begin with, I want to start with the quick commerce basket of the likes of Zomato and Swiggy. In fact, I think exactly 2 listed on the market. So, we've seen this new development of NRAI and the restaurants going up in arms. They are knocking on the doors of CCI, really alleging that Zomato and Swiggy have been using data from the restaurants to build their own private labels. Is this something that is likely to have an impact on the stock over the next few years? And overall, quick commerce saw this rapid rise in the year 2024. Now, some analysts are thinking that perhaps it is likely to consolidate or slow down in the year 2025. What is your long-term call on Zomato and Swiggy?
Look, I think given the demographics in which we are operating, Kartik, it's very hard to build a case which is not favorable for these 2 players. Only way you can build a case against these 2 players in the market is quoting valuations and sometimes quoting profitability and cash flows and so on and so forth. But my sense is the way these 2 are changing this entire spectrum digitally. I think hats off to the 2 players, the way they have kind of built these businesses. It's not just food delivery now. It's the quick commerce thing which is actually fighting. So you have the 10-minute delivery things from both of these guys, and you also are now getting into a space where they will deliver your food within 10 minutes, right? So those are spaces which are unseen, unheard, and in a demographically challenged country, in a country where infra is crumbled at multiple places, to give these kind of deliveries and quick services to clients, I think it calls for a lot. My sense is I'm long-term extremely positive on both the players, because finally it's a duopoly market. Maybe it's challenged to some extent by a big basket and Zepto in the private market. But again, if you see the overall shape and scale of things, I think we have hardly scratched the surface when in terms of operations and in terms of number of cities in which these players are gaining scale and momentum. So I am long-term positive on these 2 players. In the short term, which is immediate 1 year, 1.5 years, it's very difficult to call out because market might have different concerns. Right now, we've moved out from a phase of market where all these players were gaining traction. Perhaps the market cycle changes, the sector rotation kind of takes place, and maybe for some time these just about float. But I'm long-term positive on these 2 players.
Okay, and what about the IT stocks? I want to discuss all the IT stocks, the big ones out there, including HCL Tech and TCS, that have released their Q3 numbers, and of course the other ones including Wipro, Infosys, and also Coforge. Where do you see the entire IT sector now, again with Trump and Trump-induced politics on tariffs and H-1B visas on one side, and overall the kind of volatility and the slide that we've seen in the rupee? Where do you see, which are your top picks if one wants to invest in the Indian IT story over the next 1 year or so?
Look, Kartik, I think for last 1.5 years, I've been extremely bullish on the IT space per se, and I've come out on your shows multiple times and voiced that out because it's a highly leveraged sector to the rate cut cycle, and with the rate cut cycle kicking off in US, I think the sector has done exceedingly well. US economy showing strength adds that much more impetus to the overall sector because bulk of the IT exports and IT services or the market, the bigger market is US actually, right? And if US companies does well, I think that augurs well not just for Indian IT companies but across the world, IT sector per se booms. With new technologies being in focus, with AI being in focus, and with now quantum computing kind of gaining traction, I think you will keep finding niche and corners in IT which will surprise the world to a large extent, right? It was AI for last one and a half years, and perhaps it is quantum computing going forward for next one and a half years, right? So you never know. You will keep finding those niche areas which will surprise, and there would be companies in mid cap space in IT which will kind of excel on those fronts. But overall, as a pack, I think mid-cap IT has done exceedingly well for last one and a half years. And my sense is for next 6 odd months, I think large-cap IT would just hold and give you a relative outperformance to the market, right? When I say relative outperformance, it could be a very low single-digit number also, where the overall market might not do exceedingly well. But I continue to remain bullish from a 6 months to a 1 year perspective on the IT space.
All right. Well, continue to remain bullish for 6 months to a year. Mohit Gang, we leave it at that. Thank you so much for taking out time and joining us this morning with all your inputs.
Thank you.
Well, with that, we'll head into a quick break right here on Morning Brief at 9. A lot more coming up on the other side. Stay tuned.
I will take you to Paris.
Paris नहीं, Paris. तुम्हारा pronunciation भी ना, तुम्हारे इरादे की तक.
मैडम इरादे कभी ऑफ नहीं होते हैं, टेक ऑफ करते हैं.
SBI Life Smart Platina Supreme के guaranteed return से करो पूरे अपने इरादे, अपनों से किए सभी वादे. SBI Life, अपने लिए, अपनों के लिए.
A deep dive into what matters to you the most. Angles you won't find anywhere else. News that impacts your life.
What is to the nines? In literal terms, it's perfection. But to us, it's not just a phrase, it's an attitude. One that starts at your desk and sends a statement to the world. To the nines is about taking charge. It's a way of life where every seam, every fold, is crafted with excellence. It's timeless elegance and uncompromising quality made for the corner office. It's the ideas that inspire redefining order and elevating the tabletop. To the nines, for the leaders of today and the visionaries of tomorrow.
In the chaos of battle, one weapon stands as a silent reaper of the battlefield. It can kill at ranges of over 3 kilometers. Just one precise shot can shatter enemy lines, disrupt entire formations, and tip the scales of war. This is a weapon born in Bharat, and it's crafted to take on the best in the world. This is the Triple S Defense Sabre, and you're watching Guns of India.
This and more. Streaming on News 9 Plus. Subscribe and get free vouchers.
India spends $75 billion on foreign cargo vessels.
$75 billion per annum. You know, that's a lot of money.
Imagine a situation where 95% of our cargo is coming on ships which are not owned by us. If we are still not prepared, if someone were to say that we are not going to give you ships, then we'll be stuck. So the entire nation's economy is at risk.
We are very clear that shipping is also strategic, because without that you can't really be the third largest economy in the world.
This and more. Streaming on News 9 Plus. News is now content. Subscribe and get free vouchers.
Welcome back. You're watching Morning Brief at 9 right here on News 9 Live. Well, another developing story comes days ahead of Donald Trump's swearing-in ceremony on the 20th of January. Now, India's Ministry of Heavy Industry has reportedly extended an invitation to Elon Musk along with a host of other major global and domestic EV makers. This is for a high-level stakeholder consultation meeting. This meeting is expected to finalize the guidelines for the scheme to promote manufacturing of electric passenger cars in India. Now, simply put, the new EV policy. Now, this is as per a report by the Financial Express. This would be the second round of consultations on the guidelines that have been delayed by around 8 months due to elections in India last year. First unveiled in March 2024, the EV policy has been designed to attract global automakers to invest in India while bolstering domestic manufacturing of electric vehicles as well as its ancillaries, including batteries as well as charging infrastructure. The scheme provides incentives for global EV manufacturers to establish production facilities in India while mandating significant investments in local manufacturing as well as supply chain. This policy also proposes to reduce import duties for automakers who commit to investing a minimum of $500 million, which is approximately 4,150 crore rupees in India, along with achieving 25% domestic value addition within 3 years of operations and 50% by the 5th year. For qualifying manufacturers, import taxes on electric vehicle priced above $35,000, including CIF, which means cost, insurance and freight, will be slashed to 15% from the current rates of 70% to 100%. The upcoming consultation is expected to witness participation from global EV leaders including Tesla, Hyundai, BMW, Mercedes-Benz, Kia, Toyota and Renault-Nissan, as well as Indian automakers like Tata Motors, Maruti Suzuki and Mahindra. Remember, this is as per a report by Financial Express. News 9 Live has not been able to independently verify this particular consultation meeting and the invitation to Elon Musk and Tesla to join. However, talks of Elon Musk coming to India had tanked last year when there were other pressing Tesla matters that Elon Musk said he had to attend to, and hence Tesla's entry into India, touted to be one of those iconic moments and a milestone for India's auto sector, got delayed, if not deferred indefinitely. Moving on to other top global stories making news today. Lawsuit woes continue for iPhone giant Apple. Just after settling a $95 million case on Siri, Apple faces fresh charges of abusing its dominant position and charging app developers an unfair 30% commission through its App Store. A London tribunal hearing the case has said this move by Apple has costed British consumers a whopping $1.8 billion. Here's a report.
Apple has abused its dominant position and cost British consumers up to $1.8 billion. That was what a London tribunal heard on Monday. The US tech giant is accused of charging app developers an unfair 30% commission through its App Store. Apple faces a mass lawsuit brought on behalf of around 20 million iPhone and iPad users in the UK. They were allegedly overcharged for app purchases. Apple argues the case is meritless. The firm also believes it overlooks the benefits to consumers of the integrated approach of its iOS operating system, which prioritizes security and privacy. It's the first mass lawsuit against a tech giant to come to trial under Britain's growing class action style regime. Many other cases are waiting to move forward against the likes of Google, Meta and Amazon. Rachel Kent is a British academic bringing the case. She argues Apple has made exorbitant profits by excluding all competition for the distribution of apps and in-app purchases. Her lawyers argue this dominant position allows the company to impose restrictive terms on app developers. They say it also allows them to charge excessive commission, which they believe is taken on by consumers. Apple has faced pressure from regulators in the US and Europe over the fees it charges third-party developers. The firm argues 85% of developers do not pay any commission at all. The trial is due to last 7 weeks and expected to hear evidence from Apple's chief financial officer later this week.
Meanwhile, Tesla has overtaken one of Germany's most prized premium brands of automobiles despite selling fewer vehicles than expected. That's right, we are talking about Tesla overtaking the German Audi. The company's year of sales growth may be on a downturn, but the American automaker managed to claim a big scalp. Tesla, for the first time, sold more cars than Audi. Audi's sales fell by 12% to 1.67 million units last year, that is 2024, despite a climb in 2023, while the registrations of Tesla vehicles dropped 1.1% in 2024, but it still shifted 1.97 million cars. That's right, Tesla and Audi both registering a decline in sales, but the rate of decline for Tesla much lower than that of Audi, and Tesla managing to sell more cars than the German automaker. On to US markets now. Stocks ended mostly higher on Monday, with the S&P 500 bouncing off a 2-month low as US Treasury yields stayed elevated, with investors dialing back expectations on the pace of interest rate cuts from the Federal Reserve. Remember, the Federal Reserve, which was touted to cut rates by another 25 basis points, may be looking at the job market data and saying that there may not be any need to cut rates for the next few months. Here's a report.
Stocks finished mostly higher Monday, with the S&P 500 bouncing off a 2-month low as U.S. Treasury yields stayed elevated, with investors dialing back expectations on the pace of interest rate cuts from the Federal Reserve. The Dow added almost 0.9%, while the S&P ended just slightly higher, but the Nasdaq fell nearly 0.4%. The Dow benefited from a 4% rise in United Health Group, after President Joe Biden's administration proposed 2026 reimbursement rates for Medicare Advantage plans run by private insurers, which would result in a 2.2% increase in payments. Treasury yields edged higher, with the benchmark 10-year note yield touching a 14-month high above 4.8%. Markets are currently pricing in one rate cut from the Fed this year, as inflation remains above the central bank's target and the economy continues to grow at a healthy clip. Winthrop Capital Management Chief Investment Officer Adam Coons remains cautious on stocks.
Most likely, we're going to have this dynamic where you're going to continue to see markets focused on what the Fed's doing and the health of the U.S. economy, which right now is very, very strong, but as soon as we see anything that shows that the U.S. economy might be turning over, I think you're going to see heightened volatility. So I think that's the thing to watch is, the economic data is probably going to have a heightened level of scrutiny this year because people will just continue to have this forecast that U.S. has to have a recession that hasn't happened in the last 2 years. And so you're going to have an increased kind of sensitivity to that within markets here in the next 6 months.
Other stocks on the move included Nvidia, which slipped 2%. After the U.S. government said it would further restrict artificial intelligence chip and technology exports. And Moderna plunged 17%, making it the biggest decliner on the S&P 500 after slashing its 2025 sales forecast by $1 billion.
Well, with that, it's time for another short break right here on Morning Brief at 9. On the other side of the break, we'll get you all the latest on the LA wildfires, and this time the situation getting further exacerbated with the Santa Ana winds likely to cause even more disruption. That and more on the other side of this break.
He said, Thomas, if it were not for my grandmother, who was my light of my life, I would have stayed back in the US and married the girl who I loved and I wanted to marry. He said, 2 things brought me back to India. Number 1 is that my grandmother, who meant everything to me, she took ill. And the other half was that grandmother used to always tell him, please understand, Tata stand for certain principles and normative values. At some point of time in your career, you will have to embrace it unfailingly and ensure that there is no deviation from the path which Jamshedji, the founder, had shown for the entire Tata family.
This and more. Streaming on News 9 Plus. News is now content. Subscribe and get free vouchers.
A deep dive into what matters to you the most. Angles you won't find anywhere else. News that impacts your life.
What is to the nines? In literal terms, it's perfection. But to us, it's not just a phrase, it's an attitude. One that starts at your desk and sends a statement to the world. To the nines is about taking charge. It's a way of life where every seam, every fold, is crafted with excellence. It's timeless elegance and uncompromising quality made for the corner office. It's the ideas that inspire redefining order and elevating the tabletop. To the nines, for the leaders of today and the visionaries of tomorrow.
Welcome back. You're watching Morning Brief at 9. On to other global stories in news today. British Finance Minister Rachel Reeves, facing criticism for travelling to China during financial market turmoil at home, has said she will act to ensure the government's fiscal rules are met. She also defended her budget at the start of the two-day visit to China and said that China's pragmatic and predictable relations with Beijing would help boost growth and trade. Take a look.
Britain's finance minister, who has faced criticism for travelling to China during market turmoil at home, said on Saturday pragmatic and predictable relations with Beijing would help boost growth and trade. Rachel Reeves was on a two-day trip to revive high-level economic and financial talks that have been frozen for nearly 6 years. Under fire because of a sharp rise in British interest rates, Reeves also defended her latest budget.
The fiscal rules that I set out in my budget in October are non-negotiable, and growth is the number one mission of this government, to make our country better off. And that's why I'm in China, to unlock tangible benefits for British businesses exporting and trading around the world.
Last year, British Prime Minister Keir Starmer, elected in July, and Chinese President Xi Jinping launched the first dialogue between the two countries' leaders since 2018. Reeves said re-engaging with China would deliver trade worth $730 million to the British economy over the next 5 years. China is Britain's fourth largest trading partner. Starmer's aim of boosting trade with China may become more difficult if US President-elect Donald Trump follows through on his threat to impose tariffs on all imports. Asked whether Britain would follow Washington and Brussels in imposing tariffs on Chinese electric vehicles, Reeves said British car manufacturers export substantially to Chinese markets and that Westminster would take decisions in the national interest. Britain's interest rate rise, due in part to a global bond sell-off, has drawn comparisons with the 2022 mini-budget crisis that forced then Prime Minister Liz Truss out of Downing Street. However, this week's market moves have been less sharp, and there's so far no evidence of that level of strain on institutional investors.
And staying with Euro, Berlin has sounded out potential buyers for Uniper in a deal that could see the government selling its entire holding in the $18.8 billion energy utility. Germany's government owns over 99% of the company after nationalizing it in 2022 during Europe's energy crisis. More details in this report.
Berlin has sounded out potential buyers for Uniper, according to 3 people with knowledge of the matter. A deal could see the government selling its entire holding in the $18.8 billion energy utility. Germany's government owns over 99% of the company after nationalising it in 2022 during Europe's energy crisis. It's reportedly pursuing a partial stake sale or re-IPO of around 25% as a preferred option. The sources added it's also weighing exiting its holding in one go, and that the parties that have been approached about a full sale include Canadian fund Brookfield. A full sale to a private equity fund would be one of Europe's biggest in recent years. Uniper nearly collapsed after its former main gas supplier, Russia's Gazprom, first curbed and later stopped deliveries after the outbreak of the Ukraine war. The German government stepped in to ensure energy security in Europe's biggest economy. Its finance ministry said on Monday the government was examining all scenarios to cut its stake. It reiterated that the leading option for the reprivatisation was selling shares via the equity market. Uniper and Brookfield both declined to comment. The sale talks come as Germany prepares for a snap election next month. While a new government's plans for the holding are as yet unclear, it will still be held to EU regulations, obliging it to cut its Uniper stake to a maximum 25% plus one share by 2028.
On to the US now. In a move that will aim to keep advanced computing prowess within the United States, the US government has announced its plan to further restrict exports of artificial intelligence chips. The US will place new limits on advanced graphic processing units or GPUs, which are used to power data centers needed to train AI models, most of which are made by NVIDIA. Stocks of NVIDIA tumbled by 5% on this news. Here's a report.
Shares of NVIDIA fell as much as 5% Monday morning, after the U.S. government said it would further restrict exports of artificial intelligence chips. The new regulations are aimed at keeping advanced computing power in the United States and among its allies, while finding more ways to block China's access. The U.S. will place new limits on advanced graphics processing units, or GPUs, which are used to power data centers needed to train AI models, most of which are made by NVIDIA. The company called the rules sweeping overreach and said the White House would be clamping down on technology that is already available in mainstream gaming PCs and consumer hardware. The restrictions do not apply to gaming chips. The regulations cap a 4-year effort by the administration of U.S. President Joe Biden to hobble China's access to advanced chips that can enhance its military capabilities and seek to maintain U.S. leadership in AI by closing loopholes and adding new guardrails to control the flow of chips. While it is unclear how President-elect Donald Trump's incoming administration will enforce the new rules, the two administrations share similar views on the competitive threat from China. The regulation is set to take effect 120 days from publication, giving the Trump administration time to weigh in. The policy would also impose new rules on companies involved in data centers like Oracle, Microsoft, and Amazon, whose shares also fell Monday morning.
In a major shift in the global oil market, China and India are set to source more crude from the Middle East, Africa and the United States. This change comes in response to new US sanctions targeting Russian oil producers and vessels called the Shadow Fleet, which are expected to significantly curb supplies to Moscow's primary customers, particularly in Asia. Take a look.
Chinese and Indian refiners are scouring the globe for supplies of crude, according to traders speaking to Reuters. It follows a move by the US last week to impose sanctions on Russian oil producers Gazprom Neft and Surgutneft Gas, plus 183 vessels that have shipped Russian oil. The sanctions target revenues Moscow has used to fund its war with Ukraine. On Monday, China reiterated its opposition to unilateral US sanctions. Many of the tankers have been used to ship oil to India and China, as Western sanctions and a price cap shifted trade in Russian oil from Europe to Asia. Some tankers have also shipped oil from Iran, which is also under sanctions. Russian oil exports are expected to be hurt severely by the new sanctions, according to two Chinese trade sources. The expected disruption in Russian supply drove global oil prices to their highest in months on Monday. Among the newly sanctioned ships, 143 are oil tankers that handled more than 530 million barrels of Russian crude last year. One analyst told Reuters that's about 42% of the country's total seaborne crude exports. He added that of these, about 300 million barrels were shipped to China, while the bulk of the remainder went to India. The new sanctions could push China and India back into the compliant oil market to seek more supply from the Middle East, Africa and the Americas. Spot prices for Middle East, Africa and Brazilian grades have already risen in recent months on rising demand.
In what is shaping up to be one of the deadliest wildfire seasons in California's history, the Palisades fire, which erupted just a few days ago, has already carved a path of destruction. Fueled by Hurricane Force Santa Ana winds, the inferno ignited and within 24 hours scorched over 17,000 acres. Entire neighborhoods have been reduced to ashes, forcing families to flee with little more than the clothes on their backs. The U.S. National Weather Service has warned that strong winds and lingering dry weather are expected to worsen firefighting efforts in Los Angeles and Ventura counties. Firefighters are racing against time as dangerously dry Santa Ana winds reaching speeds of 50 to 70 miles per hour return to the region. These winds, combined with extremely dry vegetation, could fuel the rapid spread of existing and new wildfires. The devastation is staggering. At least 24 lives have been lost, with over 8,500 firefighters working to douse the fires. Addressing recovery efforts, President Biden said California fire recovery will cost tens of billions of dollars. Los Angeles mayor meanwhile warned that wind speeds could approach hurricane force levels. Resources from across the country, state and even overseas have been mobilized to combat the crisis. And that's all we have for you on Morning Brief at 9. News and updates continue right here on News 9 Live, so stay tuned.
It's not the fiefdom of politicians. They owe it to the people. Matter is now more about faith of the millions of devotees than just political slugfest. Does that mean that I can't get a job in Chennai, although I may be best suited for that particular job? They have more civic sense, they have more of civility than all these men. My name is Sudha Sadanand. Welcome to the South Indian.
What is to the nines? In literal terms, it's perfection. But to us, it's not just a phrase, it's an attitude. One that starts at your desk and sends a statement to the world. To the nines is about taking charge. It's a way of life where every seam, every fold, is crafted with excellence. It's timeless elegance and uncompromising quality made for the corner office. It's the ideas that inspire redefining order and elevating the tabletop. To the nines, for the leaders of today and the visionaries of tomorrow.
A deep dive into what matters to you the most. Angles you won't find anywhere else. News that impacts your life.
History for a reason tonight.
Will it change the shape of American foreign policy? Violence has erupted in Manipur once again. How can we pass judgment, sir, before any inquiry that they were volunteers or militants, sir?
In the chaos of battle, one weapon stands as a silent reaper of the battlefield. It can kill at ranges of over 3 kilometers. Just one precise shot can shatter enemy lines, disrupt entire formations, and tip the scales of war. This is a weapon born in Bharat, and it's crafted to take on the best in the world. This is the Triple S Defense Sabre, and you're watching Guns of India.
This and more. Streaming on News 9 Plus. Subscribe and get free vouchers.
India spends $75 billion on foreign cargo vessels.
$71 billion per annum. That's a lot of money.
Imagine a situation where 95% of our cargo is coming on ships which are not owned by us. If we are still not prepared, if someone were to say that we are not going to give you ships, then we'll be stuck. So the entire nation's economy is at risk.
We are very clear that